Hello everyone, welcome back to my YouTube channel. My name is Ayu Endalestari, you can call me Ayu. I'm a student of Mercubuana University majoring in accounting. In this video, I will explain about stock markets. Okay, let's go straight to the video. Happy watching! What is the stock market? The stock market broadly refers to the collections of exchange and other venues where the buying, selling, and issuance of shares of publicly held companies take place. Such financial activities are conducted through institutional formal exchange, whether physical or electronic, or via over-the-counter or OTC marketplace that operate under a defined set of regulations. While both the terms stock market and stock exchange are often used interchangeably, the latter term generally comprises a subset of the former. If one trades in the stock market, it means that they buy or sell shares on one or more of the stock exchange that are part of the overall stock market. A given country or region may have one or more exchanges comprising their stock market. The leading U.S. stock exchange include the New York Stock Exchange and the Nasdaq. This leading national exchange, along with several other exchanges operating in the country from the stock market of the United States. Key takeaways: stock markets are venues where buyers and sellers meet to exchange equity shares of public corporations. Stock markets are vital components of the free market economy because they enable democratic access to trading and exchange of capital for investors of all kinds. They perform several functions in markets, including efficient price discovery and efficient dealing. In the United States, the stock market is regulated by the Securities and Exchange Commissions, or SEC, and local regulatory bodies. Understanding the stock market. The stock market allows numerous buyers and sellers of securities to meet, interact, and transact. Stock markets allow for price discovery for shares of corporations and serve as a barometer for the overall economy. Since the number of stock market participants is huge, one can often be assured of a fair price and a high degree of liquidity as various market participants compete with one another for the best price. A stock market is a regulated and controlled environment. In the United States, the main regulators include the Securities and Exchange Commissions, or SEC, and market participants under the purview of the Financial Industry Regulatory Authority, or FINRA. Since the stock market brings together hundreds of thousands of market participants who wish to buy and sell shares, it ensures fair pricing practices and transparency in transactions. While earlier, stock markets used to issue and deal in paper-based physical share certificates, the modern-day computerized stock markets operate electronically. How the stock market works? In a nutshell, stock markets provide a secure and regulated environment where market participants can transact in shares and other eligible financial instruments with confidence, with zero to low operational risk. Operating under the defined rules as stated by the regulator, the stock markets act as primary markets and secondary markets. As a primary market, the stock market allows companies to issue and sell their shares to the common public for the first time through the process of an initial public offering, or IPO. This activity helps companies raise necessary capital from investors into a number of shares, for example, 20 million shares, and sells a part of the shares, say 5 million shares, to the public at a price, for instance, $10 per share. To facilitate the process, a company needs a marketplace where the shares can be sold. This marketplace is provided by the stock market. If everything goes according to plan, then the company will successfully sell the 5 million shares at the price of $10 per share and collect $15 million worth of funds. Investor will get the company shares, which They can expect to hold for their preferred durations in anticipation of rising in share price and any potential income in the form of dividend payments. The stock exchange acts as a facilitator for this capital raising process and receives a fee for its services from the company and its financial partners. Following the first-time share issuance IPO exercise called the listing processes, the stock exchange also serves as the trading platform that facilitates regulator buying and selling of the list shares. This constitutes the secondary market. The stock exchange earns a fee for every trade that occurs on its platform during secondary market activity. Functions of a stock market. First, fair dealing in securities transactions. Depending on the standard rules of supply and demand, the stock exchange needs to ensure that all interested market participants have instant access to data for all buy and sell orders, thereby helping in the fair and transparent pricing of securities. Additionally, it should also perform efficient matching of appropriate buy and sell orders. 2. Efficient price discovery. Stock market needs to support an efficient mechanism for price discovery, which refers to the act of deciding to proper price and a security and is usually performed by assessing market supply and demand and other factors associated with the transactions. Liquidity maintenance. While getting the number of buyers and sellers for a particular financial security are out of control for the stock market, it needs to ensure that whoever is qualified and willing to trade gets instant access to place order that should get executed at a fair price. Next, security and validity of transactions. While more participants are important for the efficient working of the market, the same market needs to ensure that all participants are verified and remain compliant with the necessary rules and regulations, leaving no room for default by any of the parties. Additionally, it should ensure that all associated entities operating in the market adhere to the rules and work within the legal framework given by the regulator. Support all eligible types of market participants. A marketplace is made up of a variety of participants which include market maker, investor, trader, speculators, and hedgers. All of these participants operate in the stock market with different rules and functions. For instance, an investor may buy stocks and hold them for a long term, spanning many years, while a trader may enter and exit a position within seconds. A market maker provides necessary liquidity in the market, while a hedger may like a trade in derivatives for mitigating the risk involved in investments. Next, investor protections. Along with weekly and institutional investors, a very large number of small investors are also served by the stock market for their small amount of investments. This investor may have limited financial knowledge and not be fully aware of its pitfalls of investing in stocks and other listed instrumentals. The stock exchange must implement necessary measures to offer the necessary protections to such investors to shield them from financial loss and ensure customer trust. Balance sheet regulations. These companies are largely regulated and their dealings are monitored by market regulators such as the above-mentioned SEC. Additionally, exchange mandates certain requirements, for example, timely filing for quarterly financial reports and instant reporting of any relevant developments to ensure that all market participants become aware of corporate happenings. Failure to adhere to the regulations can lead to suspensions of trading by the exchange and other disciplinary measures. Regulating the stock markets. A local financial regulator or competent monetary authority or institute is assigned the task of regulating the stock market of a country. The SEC is a regulatory body charged with overseeing the U.S. stock markets. The SEC is a federal agency that works independently of the government and political pressure. The mission of SEC is just as protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formations. Next, stock market participants. Along with long-term investors and short-term traders, many different types of players are associated with the stock markets. Each has a unique role, but many of the roles are intertwined and depend on each other to make the market run effectively. First, stockbrokers, also known as a registered representative in the United States, are licensed professionals who buy and sell securities on behalf of investors. Portfolio managers are professionals who invest portfolios or collections of securities for clients. Investment banker represents companies in various capacities, such as private companies that want to go public via an IPO or companies that are involved in pending merger and acquisitions. Custodians and depot services providers are institutions that hold on the customer securities for safekeeping to minimize the risk of their theft or loss. Market makers are broker-dealers who facilitate the trading of shares by posting bid and ask price and maintaining an inventory of shares. Speculators engage in directional bets in the market with individual stocks or broader indexes. Next, arbitrageurs are traders who identify mispricing in the market for relatively low-risk profits. Stock exchange operate as for-profit institutes and charge a fee for their services. Competition faced by stock markets. While individual stock exchanges compete against each other to get maximum transaction volume, stock market as a whole may be facing competitive threats on two fronts. First, dark pools. Dark pools, which are private exchange or forums for securities trading and operate within private groups, are posing a challenge to public stock markets. Though their legal validity is subject to local regulations, they are gaining popularity as participants save big on transaction fees. Blockchain ventures. Amid the rising popularity of blockchain, many crypto exchanges have emerged. Such exchanges are venues for trading cryptocurrencies and derivatives associated with that asset class. Though their popularity remains limited, they pose a threat to the traditional stock market model by automating a bulk of the work done by various stock market participants and by offering zero to low-cost services.